For the first time in history, every single recipient of the full state pension is set to pay income tax, a seismic shift that has sparked alarm among retirees and financial experts alike. But here's where it gets controversial. This isn't a direct tax hike announced in a budget speech. It's a stealthy consequence of frozen tax thresholds and rising pension values. By 2027-28, 100% of full state pensioners will owe tax on their payments, up from less than half today, according to a startling analysis by the Institute for Fiscal Studies, IFS. The root of this change, the government's decision to freeze tax thresholds while the state pension continues to rise thanks to the triple lock mechanism. This means the full new state pension will surpass the £12,570 personal allowance threshold, dragging millions of pensioners into the tax net. And this is the part most people miss. It's not just about paying more tax. It's about a fundamental shift in how the state pension is treated for tax purposes. One that could have far-reaching consequences. Last year, Chancellor Rachel Reeves vowed not to extend the freeze, arguing it would harm working people. But with public finances in dire straits, she's now expected to backtrack, potentially extending the freeze until April 2030. The IFS estimates this move alone could raise £8.3 billion in a single year. While this might seem like a win for the Treasury, it's a double-edged sword. Here's the kicker. Freezing thresholds effectively acts as a stealth tax, pushing more people into higher tax brackets as wages and inflation rise, without the government ever raising headline tax rates. Critics argue this approach is deeply unfair, particularly for pensioners on fixed incomes. The IFS warns that the fallout goes beyond higher tax bills. For instance, single pensioners relying solely on the state pension could see their net income drop below benefit thresholds, making them eligible for pension credit. This, in turn, could open the door to additional benefits like free TV licenses, but at the cost of navigating complex bureaucratic systems. Is this a fair trade-off, or a hidden penalty for retirees? Matthew Olton, a research economist at the IFS, bluntly stated, the freezes to personal tax thresholds have already represented a huge tax rise. Extending them would raise significant revenue in a broad-based and progressive way. But progressivity comes at a cost. Lower-paid workers, for example, would see the value of their wage increases eroded as the Treasury claims a larger share through taxation. The Treasury, however, defends its stance, pointing to the triple lock's £470 annual increase for 12 million pensioners and efforts to boost pension credit uptake. Yet, Liberal Democrat Deputy Leader Daisy Cooper MP slammed the policy as yet another unfair measure that will penalize pensioners and hammer the low-paid. So, here's the question. Is this a necessary fiscal measure in tough economic times, or a sneaky way to balance the books on the backs of retirees and low-income workers? Let's hear your thoughts. Do you agree with the government's approach, or is this a step too far? Share your views in the comments below.